Most retail traders in the United States spend their first 3 to 5 years chasing lagging technical indicators. They stack their charts with relative strength index, moving average convergence divergence, Bollinger Bands, and stochastic oscillators. However, every single one of these price-based indicators is derived strictly from historical close prices. They are mathematical prints of what has already transpired in the market. There is only one true leading indicator available on standard charting platforms that exposes institutional activity in real time, and that is volume. Price simply tells you where the market transacted at a specific millisecond. Volume, on the other hand, reveals who conducted that transaction, how aggressive they were, and the exact amount of capital committed to that move. If you execute trades based purely on price action, without evaluating the underlying volume structure, you are attempting to read a balance sheet with half the numbers redacted. When you trade equities on the New York Stock Exchange, equity options, or CME futures contracts like the S&P 500 E-mini, you are participating in a zero-sum game against institutional market makers, algorithmic high-frequency trading firms, and multi-billion-dollar hedge funds. These entities cannot hide their size. Because of strict market compliance and order routing mechanics, every time a large market participant fills a position, they leave a physical print on the volume histogram. We must systematically dissect volume analysis by eliminating the motivational noise and focusing exclusively on institutional order flow mechanics, effort versus result dynamics, and actionable volume footprints. By mastering this framework, you can identify where institutional money is accumulating or distributing, allowing you to align your capital with the dominant trend rather than becoming market maker liquidity. To understand volume at an institutional level, we must first establish a firm mental distinction between price and volume through the framework of auction market theory. Price is the advertising mechanism of the market. Its sole purpose is to move up and down to facilitate trade between buyers and sellers, constantly searching for fair value. Volume is the ultimate measurement of market efficiency and acceptance. High volume at a specific price zone indicates that both buyers and sellers agree that the area represents fair value, leading to heavy transaction flow. Low volume at a price zone indicates market inefficiency and rejection, meaning price moved through that region simply because there was a lack of resting liquidity on the order book. Consider a car climbing a steep incline. The distance the vehicle travels up the road represents price. The amount of force applied to the gas pedal, the revolutions per minute of the engine, represents volume. If a car is traveling uphill at 50 miles per hour and the driver maintains moderate gas pressure, the movement is efficient. However, if the car slows down to 10 miles per hour while the driver slams the gas pedal to the floorboard and the engine hits redline, you immediately recognize a mechanical anomaly. The effort being exerted is completely disproportionate to the distance being traveled. The exact same physical law applies to financial charts. Let's examine a real-world case study using QQQ, the Invesco QQQ Trust, tracking the NASDAQ 100 index. Assume QQQ has spent 3 consecutive weeks consolidating in a tight multi-day bracket between $440 and $450. On Monday, at the 9:30 a.m. Eastern Standard Time New York Open, a wide-range green candle expands violently past the $450 resistance level, reaching $454 by the mid-morning session. Retail momentum traders, seeing a textbook technical breakout on their charts, immediately buy call options or push market buy orders into the tape. However, an evaluation of the lower volume pane reveals that during this entire $4 expansion, trading volume printed 45% below the 20-day relative volume average. The absence of heavy volume demonstrates that institutional buy desks did not aggressively bid up the stock. Instead, price drifted upward effortlessly because there was a temporarily empty order book, a total absence of sell limit orders sitting above the $450 level. Because there was no passive supply offering resistance, A small amount of retail buying pushed the price up into a vacuum. The moment QQQ reached $454, institutional sell desks stepped in, filled their massive supply orders against the incoming retail buying frenzy, and pushed the ETF straight back down into the previous range at $442. This classic maneuver is known as a low-volume expansion trap. Without high relative volume confirming institutional participation, a price breakout is merely an illusion of strength caused by thin market depth. The second foundational step in professional volume analysis is the operational application of Richard D. Wyckoff's law of effort versus result. In market mechanics, effort is defined as the total volume printed over a specific time frame, representing the raw capital expended by market participants. Result is defined as the spread of the price candle, measured strictly from the candle's high to its low, along with the directional movement achieved. Under normal market conditions, effort and result operate in complete harmony. A large green candle with a wide price spread, accompanied by elevated, above-average volume, confirms that high effort produced a high result, validating trend continuity. However, heavy, extreme volume accompanied by a narrow price spread or a compressed candle body indicates an imbalance between effort and result. This structural anomaly is the single most reliable signature of institutional absorption. Let's analyze a concrete case study using the S&P 500 E-mini futures, ES, on a 5-minute chart during a volatile trading session. During the first hour of trading, the market experiences an aggressive liquidation sell-off, dropping 30 points in a matter of 40 minutes. Suddenly, at 10:30 a.m. Eastern Standard Time, a single 5-minute candle prints an extraordinary volume spike, say 110,000 contracts exchanged within that single 300-second window. This represents the absolute highest volume bar printed all week. Under normal circumstances, 110,000 contracts of aggressive market sell orders should smash the market down by another 15 to 20 index points. Yet, when you examine the candle structure, the physical body of the candle is extremely small, less than 3 points wide, and features a long lower wick extending downward. How did 110,000 contracts of sell volume fail to push the price down? The answer is institutional passive absorption. While retail traders were panicking and hitting the market sell button, institutional desks were sitting quietly at that precise price floor, utilizing massive passive buy limit orders to absorb every single sell contract thrown at the market. They allowed the retail crowd to sell into their resting bids without bidding the market up, accumulating a massive long inventory at wholesale prices. When you identify extreme effort paired with minimal downward result, you are witnessing the footprint of smart money accumulation. The downward trend has been systematically absorbed, setting up a sharp mean reversion squeeze to the upside. Now that you master the principle of effort versus result, we must categorize the 3 primary institutional volume signatures that regularly present themselves on U.S. equity, futures, and options charts. The first is stopping volume, which occurs precisely at the terminus of a prolonged downtrend and signals that institutional capital has stepped in to halt falling prices. Structurally, it appears as an expansive downward candle that opens high, drops sharply, but then recovers significantly before the close, leaving a prominent lower wick alongside an ultra-high relative volume bar. The heavy volume bar represents panic market selling by retail accounts, which is completely met and absorbed by institutional buy limit orders sitting at key structural support levels. You should never initiate a short trade when ultra-high volume prints on a candle with a large lower wick at support, as the momentum has been neutralized by institutional capital. The second pattern is the buying climax, which occurs at the peak of an extended uptrend, frequently accelerated by major corporate catalyst events, such as quarterly earnings beats or macroeconomic news releases. Here, price surges vertically upward with a wide-range green candle, generating an extreme volume bar, often 3 to 5 times higher than average daily volume. However, the candle fails to close at its extreme high. Instead, it closes near the midpoint or lower third of its range, leaving an upper wick. Retail traders, driven by fear of missing out, aggressively buy market orders at peak prices, while institutional market participants utilize this massive influx of retail buy-side liquidity to unload their long positions. Extreme volume at the absolute top of a multi-week run is not a sign of strength, but the final distribution print before a steep drop. The third key signature is volume divergence, which occurs when price makes a consecutive higher high while volume simultaneously prints a lower high. Consider an advanced micro devices (AMD) daily chart analysis, where AMD trends upward from $140 to $165 on strong, expanding volume bars of 60 million shares per day. The stock experiences a minor pullback to $158, then resumes its upward trajectory, pushing past its previous resistance to print a brand new high at $175. However, an inspection of the volume panel during this secondary leg reveals that daily volume has dropped to just 32 million shares, a 46% decline compared to the initial rally phase. This condition represents clear volume divergence. The market is printing higher prices, but the fuel sustaining that move has depleted. It indicates that institutional desks are no longer participating in the buying process, leaving the price drifting upward purely due to a temporary lack of immediate sell pressure. Volume analysis is not a predictive crystal ball, nor is it an isolated trading system. It is a contextual order flow framework designed to align your execution with real institutional liquidity. Before placing any trade across U.S. markets, systematically process every setup through a three-step institutional verification protocol. First, audit the context and location by checking if the asset is trading at a critical higher time frame liquidity level or key anchored VWAP. Second, run an effort versus result audit to verify whether the physical spread and body size of the current price candle logically match the magnitude of the underlying volume bar. Third, validate patterns by identifying confirmed signatures of stopping volume, buying climaxes, or structural volume divergence before risking capital. Stop treating price charts as simple two-dimensional lines. Recognize them as dynamic, real-time auctions where volume strips away the narrative and exposes who truly controls the order book.